What is the history of quantitative easing? Have you ever wondered how central banks respond to economic crises? One key tool they use is called quantitative easing. This method helps inject money into the economy, especially when traditional methods, like lowering interest rates, are not enough. Let's break down the history and implications of quantitative easing, particularly in the context of economic inequality and free market economics. Quantitative easing, often referred to as QE, is a monetary policy where central banks buy government securities or other financial assets. This process increases the money supply and lowers long-term interest rates. The United States Federal Reserve has used this strategy for times since the financial crisis of 2000. The first round, known as QE 1, took place from 2008 to 2010. The Federal Reserve purchased large amounts of mortgage-backed securities and treasury bonds. This was aimed at stabilizing financial markets and helping the economy recover from the global financial crisis. Next came QE 2, which started in November 2010 and lasted until 2011. This round focused on buying treasury securities to support economic growth as the recovery remained fragile. Then, we had QE 3 from 2012 to 2014. This phase involved purchasing both treasury bonds and mortgage-backed securities. The goal was to support the housing market and the broader economic recovery. Finally, there was QE 4, which occurred from 2019 to 2020. Although not officially labeled as QE, the Federal Reserve resumed asset purchases in response to the COVID-19 pandemic. This was done to ensure liquidity and support economic stability during a challenging time. From a conservative viewpoint, quantitative easing can be seen as government intervention in the free market. Critics argue that it may lead to increased government debt and inflation. They believe that QE can distort market signals, creating asset bubbles by inflating prices and lowering borrowing costs. Moreover, there are concerns about economic inequality. Many conservatives argue that QE disproportionately benefits those who already hold assets, such as stocks and bonds. This situation could widen the wealth gap between the rich and the poor. While quantitative easing may stimulate economic growth, it does not necessarily address the root causes of economic inequality. In summary, the history of quantitative easing highlights its role as a monetary policy tool during economic crises. While it has been credited with stabilizing markets, it also raises important questions about its impact on inequality and the free market. Understanding these dynamics is essential for anyone interested in fiscal policy and economic analysis.